Very good morning, everyone. Thanks very much indeed for attending today's webinar, European Economic Market Outlook through the Refinitiv Macro Vitals App. My name is Axel Threlfall, and I will be the moderator for the next 40 minutes or so. A couple of housekeeping points before we get started. At the bottom of the webinar screen, you'll see a toolbar. Use that to access a range of applications like speaker information, resources, technical help. Click on an application. It should open up on your screens. All of them are resizable and movable, so you can shift them around as we go. We're going to be accepting questions, so do submit those through the webinar via the Q&A box, and I'll try and get to as many of those as I can as we go. For the best viewing experience, we recommend closing any programs or browser sessions running in the background. This is going to conserve your bandwidth. The webcast is being streamed through your computer, so for the best audio quality, please do make sure your computer speakers or the headset volume is turned up. And finally, some networks cause slides to advance more slowly than others, so logging off your VPN is recommended. No doubt you've heard all of this, all of these housekeeping points before, but just wanted to go over that. We do, of course, value your feedback, so do complete, if you can, the pop-up survey at the end of the webinar. Right, just before we come to our speakers, I'm going to hand it over for a live demo of the Eikon Macro Vitals app from John Dufus. He is Director Macro and Economics, Refinitiv. He'll run us through that, and then we'll get the conversation started. John, over to you.
Thank you, Axel. I'm just sharing my screen now. And let me know when you can see it. Is it coming across, Axel?
John, yes, it is. Yeah.
Okay, excellent. Good morning and good day, everybody. Thank you for joining our webinar today. I'm going to take you through the Macro Vitals app, which is on the Eikon desktop. Give you some background about what the Macro Vitals app is all about. Basically, the concept of Macro Vitals is to give our user base somewhere to go to see the impact of a global event, whether it be a financial type event, a natural disaster, or in the case of what we're discussing today, a pandemic such as COVID-19. The idea of the Macro Vitals app is to provide our users with an overview, a high-level overview of what's going on. What is the impact of this particular macro shock? Of course, now we're talking about COVID-19. Some news around that shock. What is the market impact of the shock? The responses, whether it be the monetary authorities or the fiscal authorities, what is their response to the particular shock? And then what does the recovery look like? So I'm going to start taking you through the application, just giving you a high-level view of what's going on. Right now, we're looking at the overview page. The overview page basically meets many sort of objectives. It does provide our user base with information for webinars or videos from market analysts, economists, researchers, market commentators to get their view on the world. The topic will always be linked to the macro impact, the macroeconomic shock that the Macro Vitals app is covering. So in this case, always COVID-19. Towards the center of the overview, we have the Fathom chart of the week. For those of you who don't know, Fathom Consulting are an economics consulting firm. They are our third-party partner of choice when it comes to economics consulting, and they provide us with a chart on a weekly basis. That chart will be what they feel is coming up for the next week, going to be the most important story for the week. And below that, you will see also a short description of what they feel the story is all about. A really interesting thing to note there is we keep a historical record of their charts of the week. So if you sort of click on the link that says previous charts of the week, you'll then be able to go to another part of the application, very much showing what Fathom Consulting is all about, and then able to scroll down and see their view of the world on a weekly basis. What is the most important thing? Some of the key charts here, just to mention, for example, a lot of questions in the market are, is there going to be a V-shaped recovery, a U-shaped recovery? Is it a square U? All those types of questions. These are the kind of charts that they provide the user base and give them the opportunity to look at. Going back to the overview, we also do a lot of news. A lot of the news comes from Reuters. So we are the exclusive distributor of Reuters news when it comes to a financial desktop. And of course, IFR top news as well. IFR being a market leader in credit and FX news and analysis. Now, I mentioned at the start of the demo that we normally cover a news page, and normally it would be a single news page, but if you were looking at a financial crisis of any type of sort, or maybe a credit crisis, normally a single page would cover it. However, the pandemic is a little bit unique in the fact that not only is there a macro impact to the pandemic and a market impact, but there's also a human impact. So in that case, we've got two news tabs. We've got the macro news tab, which, as you can see here, will provide a curated, it's a page that's curated by Reuters editorial, and will provide the stories that they feel are the ones moving the markets most. So the key stories for the market. It's a breakdown between the top story, financial consequences, the big picture, and a series of different types of analytics. And this will change on a day-to-day basis, or potentially even on an intraday basis, depending on how the news flow is developing through the course of the day. So we have one tab primarily focused on the macro impact and the market impact of the pandemic. But we have a second tab, which again is unique to the COVID-19 macro shock, which focuses specifically on the pandemic itself. It focuses on news around the vaccines, the various trials that are being run in that space. It focuses on stories around global, what does a global case look, the global cases, the new cases look like, confirmed, new total deaths, total recovered. This data is, of course, sourced from Reuters itself. And you will see, as you scroll down, a series of news stories, again, curated by Reuters, that are very specific to how the pandemic itself is developing and how the medical response to the pandemic is developing. The case tracker tab, the tab that I'm now opening up, is also very unique to the COVID-19 Macro Vitals application. This is a breakdown of the cases, the recorded cases sourced by Reuters, right? So that's a very specific source for this data. And it breaks down, gives you a breakdown of the global cases, sort of what is the cumulative number, new cases, active, recovered deaths, and also compares it to what the World Health Organization is getting from its official sources in country, in the various domestic economies. The key difference between Reuters and the World Health Organization is that Reuters will try find multiple sources to get a clear picture of what's going on within a particular country, whereas the World Health Organization does rely on the statistics that come from a national source, within that country. So there are times when, as you can see here, the Reuters numbers will be slightly above that of the World Health Organization. We have the key breakdown of all the key economies here, and you will see that in the context of how does the COVID-19 affect the European markets, the Eurozone, you will see key European economies shown over here. Also, these are the ones that are also the most impacted, right? So there's an overlap there between the most impacted countries and some key European economies that unfortunately are among the most impacted countries when it comes to the pandemic. The breakdown at the bottom here between European, Western Pacific, Southeast Asia, Eastern Mediterranean, Americas, and African, that is a World Health Organization breakdown. So that's how they break down the different global regions. And we follow the World Health Organization's methodology in that respect. Now, coming to the meat of what the application is about, there is with every macro shock, whether it be a pandemic or a financial crisis, there is always a market impact. This page is basically going to provide us down the side here with a series of themes. What are the market impacts from the pandemic? We have a G20 impact, we have an emerging market impact, and a Middle East and North Africa impact. The G20 impact, because those countries cover predominantly the developed markets of the world and some of the larger emerging markets. What's of key interest there is to see how the various aspects of the pandemic are affecting those markets. So we've got three charts along the top here for the G20. We're showing an oil story, the Brent crude oil price versus the container cargoes for petroleum. We've also got the U.S. Corporate Bonds Index versus the S&P Volatility Index. And then on the side here, we're showing the S&P 500 versus the Chinese Stock Index to see how those two major indices, stock indices, are performing relative to each other. The idea of this tab is if I scroll down a little bit, you've got your G20 countries listed there, and you're able through the course of the day to say, you know, on a percentage change basis, which is performing the worst, which is performing the best, or I can just go back to its standard alphabetical order. I can do the same thing with the yield. So what is the yield net change looking like? You know, so the greatest yield net change on the day is for Turkey at the moment. And of course, FX as well. FX maybe for the G20 countries are not so much of a consideration, but you will see within the emerging markets template, if you were to go there, you have the same idea. So here, of course, you know, within the G20, we have a combination of the very developed markets and the larger emerging markets. When I look on a percent change basis on the way down, we see that the dollar rand, Mexico, Brazil are actually down close to 1%. Well, there we go. Dollar rand's just broken 1% on the day. So that is sort of on the G20 side. From a very European-specific perspective, you know, at the end of April, Fitch downgraded the Italian credit ratings. So we built a page covering the Italian country spreads. What is the versus that of its neighbors or the United States, for example. So we've got two key charts along the top here showing the progression in that spread over time. We can see a relatively large sort of spike up, a slight correction against the US 10-year, and then sort of plateaued out in this range here. Still higher than where it was in February, but at least it's come off from its highest points in mid-March and start of March and mid-April. What you can also do when you scroll down here, you have a series of countries down the left-hand side that you can scroll, and then by clicking on the name, you will launch the chart, which will show you the spread, how that spread has developed between, in this case, the Italian 10-year and the UK 10-year gilt. Some other things to note is we're also looking very much and covering very much a credit market view of what's going on in the world. Quite often, when you have a macro shock in the manner that we have right now, you will see that it starts off at the sovereign level. As the pandemic continues, we start seeing an increase in unemployment. We start seeing a decrease in spending, retail sales. That's also sort of preceded by a drop in industrial production. And eventually it translates into what could become a credit market event. And credit market events historically tend to be quite, they become sort of self-fulfilling prophecies, and they become sort of endemic to the entire financial market. So what we provide here is an overview of the credit market. What is the impact of the credit market? And then the breakdown of some, I'm only going to look at the US dollar one, but some international credit markets. In this case, dollar-denominated credit markets. Now, of course, this is a demo, and it's only when you're doing a demo that your bandwidth is slowing down. So my charts are taking time to load in, and you have my sincerest apologies for that. But here you will see the par yield chart. Here we go. They finally loaded in. So we have the AA, A, and BBB par yield charts, the same for the benchmark spreads, and then also the default probabilities. And if you scroll further down, you'll see it also for the BBB and CCC rated. And you get some really interesting charts there for default probabilities. So that's sort of, I think, I don't want to take too much time on the market impact. I want to show you what the monetary policy page looks like. Here we show the response of the various central banks. Here we provide an overview of what that response looks like. So you can see a timeline of how the various central banks have responded with monetary policy measures to try and prop up the economy, to shield their respective domestic economies from the impact of the pandemic. On the fiscal policy side, we have the same thing, but this is for the fiscal authorities. So what are the governments doing? So again, a breakdown of what the governments are doing to protect their economies from the impact of the pandemic. And here we'll have quite a few European countries that we're looking at. And then the final piece over here, from a recovery perspective, I feel At the moment, it's only really China that we could say has really come out of a recovery perspective into recovery. And we are looking at the Chinese charts to try and work out, will this provide us with the same information for the European market? So will the European markets follow the Chinese market? And as you can see here, we have some really sharp V-shaped recoveries so far in key economic indicators within China. On the real estate sales side, not so much, but definitely on the manufacturing side, quite a lot. And even on the non-manufacturing PMIs, quite a significant recovery. I think the key thing to also note from this, I just want to go one step back. In fact, I'll take it over here. The economic charts, when we go to the euro area, I'm going to finish on this. I'm going to finish on this slide, on this page over here. Provide a series of charts covering, from Fathom Consulting, covering the impact of the pandemic on the European economies. So what I could do, for example, if I wanted to scroll into one, sort of go into one chart in more detail, is I can, actually doesn't work on this one. You have my sincerest apologies. But here we have a breakdown of the impact on the European area, European economic area from the pandemic. These tend to update as well as and when Fathom finds new charts that they feel are relevant and interesting to a particular economic area. And that's all from my side. Axel, over to you.
All right, John, thank you very much. And by the way, we have seen the question about missing the beginning of that presentation. So there will be a recording of this, and that will go through everything, how to start the app, et cetera, et cetera. Let's get straight to our discussion. Viewers are no doubt well aware of the latest market headlines. So we do want to try and spin this forward a little bit as much as we can. Tell viewers some of the things that we're hearing, perhaps the less well-trodden ideas. Very quickly on the markets, European equities up again today. Gold has hit a record at 2,000, above 2,000. Dollar still under pressure on worries over the next aid package. Those are some of the headlines on Eikon. Mike Dolan is editor-at-large financial markets for Reuters. Sujata Rao is deputy editor financial markets, and Salah-Eddine Bouhmidi is head of markets for Germany, Austria, and the Netherlands at IG. Welcome to all of you. Mike, let me kick it off with you. I want to start with a piece that you put out this morning. It's an opinion piece you wrote, questioning the rationale behind the transatlantic switch in equities, US to Europe. Clearly, a lot of people are behind this idea, money pouring into European equities, out of the US. Why are you questioning this now? Why are people you speak to questioning this now?
Morning, Axel. Yeah, I just stress that it's not an opinion piece. It's more a take on what we're hearing. But it's very clear that the big idea at mid-year, I mean, obviously we've had a tumultuous year so far, but the big idea by mid-year was that this huge catastrophe of COVID that saw a 33% drawdown in world equity, big risk off, and then a massive response that led to a rebound in the stock markets, that by mid-year people had thought, okay, let's see where this is going, where in the world is doing well in controlling the virus, who's going to come out of it quickest, who's going to come out of it best. And one of the ideas at mid-year was that the switch between US and European equities, that the US was struggling with the virus, it was struggling to get it under control, and Europe's maybe more robust healthcare systems and more stringent lockdowns were proving, or would prove, more successful going into the second half of the year. The second thing that was driving that, of course, was the US election. A lot of interest in avoiding dollar-denominated assets ahead of November's White House race. And the third thing, of course, was final success in Europe with its recovery fund in getting across the pandemic, and also resolving some of the bigger worries about fragmentation of the Eurozone in such a crisis. That obviously involves common debt issuance and fiscal transfers that helped resolve that. So those three things thought it was a moment to move to Europe over the US. The question marks arise, of course, as we've seen through this current earnings season, which we're just over. Certainly the GDP numbers from both sides, the Q2 GDP numbers, were awful unreservedly, but the US has obviously underperformed as it was later in the pandemic. So it contracted about 8% or 8.5% quarter on quarter, where Europe was down 12. So the question is whether Europe bounces back quicker. I think the big focus has been on whether the dollar continues to fall, whether the euro move is sustainable or has already moved, and whether Europe itself faces difficulties towards the back end of the year. But the key bit from the earnings season is that US earnings were, I think, about 80% above estimates, and also, crucially, their full-year estimates for Wall Street stocks were revised higher, whereas they have not been revised higher in Europe. So the idea that the equity markets in Europe would suddenly rebound, or certainly earnings would suddenly rebound in the second half of the year, is under question now. So you're left really with a foreign exchange play to justify that switch. And therein lies a debate about all of what we just said, yeah.
And just very quickly, and Salah, I want to come on to you with this. You mentioned the dollar. I saw in your piece HSBC sticking with their 110 forecast for euro dollar on the global uncertainty, on the fragile fiscal picture in Europe. You know, when you bring in all the other sources you speak to, or some of the other research analysts and the banks, what does it stand up at 110? What are people saying?
Oh, that's a big call. Sorry.
Just let me give that to Mike very quickly, and then Salah, I'll come on to you.
Sure. Yeah, just really quickly. That's a big call, and they admitted in the piece that they sent to their clients. They've stuck with that call for a couple of years, I think. They're clearly out of the money at the moment, but they're not convinced that the economic outperformance is baked in, that Europe will bounce back as quickly. They think Europe is still fiscally more fragile, and they feel that the election will cause some worries, but ultimately the return to dollar assets will happen after November. So they think that much of the move is already done. Yeah, but it is an out of consensus call. Yeah.
Salah, what are you thinking on euro dollar now? And we've got a poll on this, a poll question, which I'll put out in just a second. But Salah, what are your thoughts on euro dollar?
Yeah, technically speaking, we are bullish, definitely. We see then the most major European euro pairs are 80% of them are trading above the 200 moving average. We see a lot of impulses that are moving to new highs that we have even seen in 2008. We have a really important resistance line that is broken right now. So technically speaking, we see a great momentum in euro, and fundamentally saying lower dollar till the election is really good for the US. So, saying it like that.
Okay. Look, here's the poll question we want to put out. Just to see what you, the viewer, is thinking. Let's put that up. You know, how high do you expect euro dollar to go by year end? It's a multiple choice. A, no higher than where it is now. B, as high as 125 but no further. And C, between 125 and 140. And D, higher than 140 is the poll question. We'll see where you come back with that. Sujata, let me bring you in here as well and talk a little bit about the ECB. I know your team has been writing about this. Given the strength of the euro, when do people expect the ECB? What level do people expect action from the ECB again?
Hi, Axel. So I think the ECB has been surprisingly quiet so far. So it's surprising, but most people reckon it's going to wait till the euro reaches about 120, and we've already had some verbal intervention from the Bank of Japan, because clearly policymakers are watching this dollar appreciation and they're not happy with what they're seeing. Bit alarmed probably, because the 10% rise in euro against the dollar is reckoned to have shaved off like 40 basis points from growth. So, and it's not good news for their inflation either. So for meeting the inflation targets, which is way out of reach at the moment already. So I think they're going to bide their time, wait till it goes till about 120 or so, and then we can probably expect some words. Not action probably just yet, but words for sure. And I tend to believe that HSBC is a really bold call, but I don't believe that the euro is going to be rising much above current levels from here.
Okay, and just this is what our viewers think. Option B seems to be leading as high as 125, but no further as well. About 59% of you saying 125, but no further. Salah, money market's not pricing in a cut for now, right?
Yeah, still waiting. I think the polls are actually saying the same. What I think as well, that we can see definitely one spot $25 in euro dollar. So, but it's not still. Markets are still waiting. We have kind of saying we have seen a first pricing in, but we are still waiting. I mean, the time of this year, 2020, is something what we never had seen before, especially me. And there is still a huge uncertainty in the market. It doesn't matter which asset class we are actually looking for.
Okay. I might as well bring poll 2 up now as well. I've got to where we are on the time. We've only got about 20 minutes. So let's put that up. Have ECB policy rates reached rock bottom at last, despite the continued use of QE? A is yes, B is no, and C is it's too early to tell. So have a crack at that one while we continue this discussion, and I'll bring you the results of that in just a second as well. Mike, of course, we talk about the transatlantic switch, and there's clearly a big debate, the US-Europe debate heating up. The other big debate that you and I have talked about often is the Wall Street versus Main Street question, and whether that can be resolved, and whether you think markets, or whether people you talk to think the markets have got this about right. Where do we stand now, based on what you're hearing?
I think the puzzle is probably less puzzling than it seems. I mean, I think from a stand-back point of view, you may think one of the worst recessions in history is a strange time to be pushing global stocks to record highs. But I think we also have to look at the policy response. It has been equally extraordinary. It's unprecedented. I think we've never seen such a preemption of credit problems, and I think you only have to look at the interest rate universe, and that's way out the yield curve, close to zero. If you translate that back into equity valuations and using discount rates as a way, or equity risk premium, then you can see where long-term valuation. But of course, it relies on the fact that the pandemic is temporary, that a vaccine arrives. But if markets are pricing 12, 18 months, then it's not that difficult to see. And it's also from within the stock market universe, it's clear what people are also pushing hard, which is tech leading the way incredibly. And we can all see around us for the last 6 months just why that is. Doesn't take a rocket scientist to work it out. But this pandemic will have catalyzed the use of cloud computing and software and internet and online retail, and you can see that in the FANGs. I think up 55% year to date is the FANG plus TM index in New York. I mean, that is staggering, and they have obviously led the way up overall. I mean, there's a slide there which will give you a run through of where the breakdown is on global stocks. Obviously NASDAQ gunning record highs still overnight. Clearly performed a V within, by early April, it almost had performed the V. Everywhere else, it's more of a lopsided V. But I think the Wall Street versus Main Street thing is understood simply by the policy response. How long they can keep that policy response going, particularly the fiscal side, is the huge question that we have going into next year. If we don't get a vaccine early, can they continue these programs? DC is debating the rollover of the benefits cliff right now at the moment. Europe will face its moment at the back end of the year as well. Much of the credit resolution support was through loan guarantees. And you can see insolvency rates in Europe collapsed year on year, right through the year, a completely bizarre statistic in the middle of a deep recession. But it's been explained by loan guarantees, which will expire at the end of the year. Who comes out of that?
So we need to be very, very wary with those numbers, is what you're saying, right?
Yeah, I think it's one of the reasons why, the positive Europe story, which has obviously very good foundations, there are question marks over it. Europe is in a very, very fragile position fiscally. Okay,
look, I want to just, we've mentioned the recovery fund, and you mentioned tech. Salah, I want to bring you in here. When we first started talking about this recovery fund in Europe, and it seemed to be hugely sort of underplayed, underestimated. It was a massive moment. There's a focus on greening of Europe's economy. There's a focus on the digitization of Europe's economy. What is this doing for some of the European technology companies? Is this making you more bullish on those companies now? Hi, Salah, can you hear me? I think you might be on mute
Sorry, yeah. It is, for me, a little bit too early to say. I mean, they started to press this recovery fund, and there's a lot of things still to do, not just to put the money out, and there needs to be an infrastructure. In Europe, we don't have an infrastructure for tech-driven companies like you can see in the US. And this is something that we need to handle here in Europe, and not just saying, come on, we put money out and then everything is okay.
Sujata, what about, okay, thank you for that, Salah, but given this greening of the European economy, and we'll leave the tech piece aside for a second, but can you dig into the green bond aspect of this recovery fund? What does this bring to the table?
This is one of the most important things from the recovery fund, and that's, even compared to the digital aspect, which Salah pointed out is still kind of amorphous. You just wait to see how that develops. But the green angle is pretty solid because, first for one, Europe already has a bit of a head start on the rest of the world on this. So if you go over the recovery fund and the 7-year budget that the EU has put out, so it's a total of 550 billion euros earmarked for the next 7 years. And that's like enormous, the biggest climate pledge ever made. So that's got several implications. So one, it's going to be about a third of the fund is going to be financed through through the issuance of green bonds from the EU. So that's going to enormously increase the amount of green bonds that are outstanding globally. So at the moment, despite all the hype we've had for years, green bonds are still less than 4% of the total outstanding amount of bonds. So if the EU does raise the amount of green bond that is volume of green bonds that is expected, it's going to almost double the amount of outstanding green bonds out there. So that's a really big deal. So that gives all these asset managers, etc., chance to buy more green bonds. And then there's the climate effect, which is obviously because all the proceeds will be going to things like renewables, wind farms, making existing buildings more green, etc. And the other angle is that there's been a lot of questioning of central banks, because they've been doing these asset purchase programs. And the question is, they should probably be this question marks of why they're buying the bonds of oil companies, of tobacco companies. So this is going to give them more green assets to invest in, and not just for their asset purchase programs, but for their reserves as well, because as we know, central banks hold huge trillions of dollars in reserves. And I think there was this recent BIS study which found that 70% of them want to buy more green bonds, for their green assets for their reserves. And here they have this. So this is a really game-changing thing.
Okay.
People hope this goes further.
Okay, thanks, Sujata. By the way, send your questions through for our speakers. We've got about 10, 15 minutes left. So if you've got any questions, send them through. I think we're going to push through the results of that second poll. It seemed to me to be pretty spread between those three options. I'll put out the final poll now as well, given we're talking about the recovery fund. Has the fund changed your long-term view of the Eurozone and Euro assets? A, yes, it's a game changer that reduces euro breakup risks. B, slightly, it's positive at the margins. And C, no, it changes nothing. So that is the final question we want to put to you, just get a sense of where you are. And while you're looking at that, the other big piece, of course, Mike, I want to come on to you with this, is the US election and what this does to the whole pot. The consensus for a while seemed to be stay away from the US until that's played out. But it seems to me that the market, and again, I don't want to put words in your mouth, but it seems to me that the market is no longer reliant on a Donald Trump tenure. It's no longer crucial for this bull market.
Yeah, I mean, I think it's an interesting question. Trump himself would like to think the stock market's stellar performance is down to his tenure, of course. And clearly, if you look at what happened at the early part of his 4 years, then you might sympathize. Tax cuts help a lot, but it's interesting that as he's fallen behind in the polls through the pandemic and with the the protests around the Black Lives Matter and all of the disruption in the States, polling is now having him somewhere in the region of 8 to 10 points behind Joe Biden. And we're in August, so it's no longer too far away. It's now within the radar, particularly of financial markets. And so to see Wall Street kind of gunning record highs with betting markets, whatever about the opinion polls, I think the predicted side has Biden something like 20 points clear of Trump at this point. Clearly the market isn't spooked by the idea of a change at the White House, and that maybe shifts that narrative slightly. I think when we get up closer to see the Biden manifesto, if you like, and what he will run into the campaign on, then we'll see a little bit more discrimination between some of the sectors and so on. Does he look to greater taxation and regulation of the big tech? What happens pharma? What's his view on corporate taxation? Those sorts of things will start to become more of an issue as we get closer to November. The uncertainty around them may think you should avoid Wall Street altogether, but as you can tell, that's not happening yet. And I think that was part of the euro-dollar transatlantic switch idea, and I think we have a question mark over it as the quarter unfolds.
Yeah. All right, Salah, what are your thoughts on this? I mean, how much volatility is it going to trigger? How much is priced in? Will the outcome change the way you think about China, Brexit, some of the other issues?
Just to sum it up real quick, election years are typically, from a seasonal perspective, good equity years. Okay, we are in Corona time, so it's maybe a bit different. But to say what I want to say to the elections, I mean, if Donald Trump will lead his way, then the conflict between China and US will actually, from my point of view, will start. So everything still is on hold. And I think, it depends on the outcome of the elections. Trump is more for me something like saying, then we're going to start. Then the trade conflict or the trade dispute will go into the limelight. If not, if Biden is winning, then I think we can see a mute or a positive impulse regarding this topic.
Okay. Thank you, Salah. Very quickly, the results for the final poll on the recovery fund. No great surprise that most of you, about 60%, said this is going to be a game changer that reduces euro breakup risks. So thank you for that. I want to come finally, again, where we are on the time here. We've got about 5 minutes. But I want to ask about Brexit. Whether markets are adequately pricing in Brexit risk. We look at sterling, I think we're at 5 months highs or thereabouts. And the reason I asked this actually is because when I was speaking to Mike Dolan yesterday about this, is the context for journalists right now is tough because everyone's looking at the same story and poring over the same details, i.e. the coronavirus and what it's doing to the markets. But what about Brexit? How is this going to play, this story? Is it going to play out, Mike, as we move forward? And what should we be looking out for in particular?
I mean, it's the gift that keeps on giving. I think some of in the marketing poll done about UBS calls it the interminably tedious UK-US or EU divorce proceedings. But October is the moment, right? So October is really where it all becomes real. If there's no deal at that point, then they essentially run out of time, or at least so the Europeans insist at the moment, out of time for ratification, etc. of before a fiscal or a no deal cliff hits us in January 1. Sterling is doing extremely well, but that's on the back of a very weak dollar. If you look at it against other currencies, less so. Also, if you look at that global stocks chart, it's staggering to watch the recovery of global stocks and to see how much the FTSE has lagged. And the FTSE is down year to date about 20%. That's about 20% underperformance against all the other major indexes, or most of the other major indexes. So there's clearly a discount in there that's related to many things, but Brexit is clearly one. It's been hanging over the UK assets for 4 or 5 years. Where does it look? It doesn't look good. I don't see any signs of major breakthroughs. There is a very significant risk that we end up in January 1 and the UK is essentially on its own trade-wise. Other parallel negotiations with the United States and Japan are going on at the meantime. But again, that gets complicated when you look at the outcome of the US election. I think Boris Johnson would have liked to have had a US deal in the can to make up for the exit in January. But if Joe Biden is no fan of Brexit and has said continuously over recent years that the UK needs to sort out its affairs with the EU, that the UK needs to sort out its affairs with the EU before he would enter into a final deal on a bilateral. So it gets very complicated. And how much of that is already in the exchange rate? I think that's hard to tell because of the dollar. I think we'll have a bumpy ride through October, though.
Yeah. Okay. Salah, how much do you think is it already in the exchange rate?
I totally agree with Mike. So it will be a bumpy road, and it's difficult to price in because people or market participants, me either, we can't predict, we can't price in this Brexit issue because since Corona came into the market, I think it will be a huge delay in this kind of Brexit topic. And I don't believe that in January all this Brexit causa will be finished. I think we will get a new extension time. For both sides, it will be the best one, I think, even for Europe or even for UK especially. So I don't believe that we will be in 2021, then that Brexit will be finished. And that's why we need to take time for pricing in. Yeah.
I'm gonna ask just for a wrap-up comment from each of you. I started this discussion by saying that we want to try and spin this forward, which we have done. Try and pull out some of the less well-trodden or counterintuitive ideas, which I think we've done a little bit of as well. But I want to finish with that, especially for Sujata and Mike. And Sujata, what do you think? And I'm putting you on the spot a little bit here, but what do you think might be some of the standout, perhaps surprising standout themes going forward on your beat?
I think what's going to be really important is to see how the COVID epidemic develops in Europe and the rest of the world compared to the US, because at the moment we've got the US suffering a lot, which basically put pressure on the dollar, etc., complicated the US election race. But if Mike mentioned this earlier, Europe was first out of the gates, but now we're seeing some kind of lockdowns being imposed in Australia. There's outbreaks in Germany. Doctors are warning of a second wave. We have a lockdown imposed in northern England. So restrictions, So I think if this happens, everybody's going to be back in the same boat. And where does that leave the equilibrium? So that's going to be very important. That will be the surprise, really, if we get a big wave across Europe. What happens then?
Okay. Very good. Thank you, Sujata. And Mike, we started with your story, Not So Fast on That Transatlantic Switch is the headline of your story out today. Any others like that, obviously, without wanting to give too much away.
No, I mean, I think one of the things that on the pandemic theme, I mean, one of the things that has driven financial markets since the March troughs has been the running assumption that a vaccine will arrive and will be a silver bullet and we'll be back to normal within 12, 18 months, with changes and behavioral changes and everything else. But ultimately, in terms of activity, we'll be back there. I think if there's any doubt that vaccines are effective, if there isn't a silver bullet in a vaccine or the many vaccines that are underway, that would be a dramatic change of thinking because then you're left with a slow burning infection for many years. The other thing in more kind of policy direction is that the central banks obviously have been pushing fiscal authorities to pick up the slack, that they can't do everything, and clearly that fiscal support is there. How long it can be sustained, particularly if there was any delay in a vaccine, is a huge question. I mean, the amounts of money being spent are gigantic. And so what do the central banks do in response? At the moment, their stance is no further cuts in policy rates, but, massive support for the huge amount of debt that are coming through. So they're effectively underwriting the government borrowing. The MMT that we continually debate and talk about is in effect underway. So how do they manage that going forward is a real question. And essentially what's happened already is that they're capping government borrowing rates. Will they continue to do that? And what if we saw an inflation pulse come through? Would they be forced to react and have some sort of exit policy that would change that picture? But at the moment, the market is assuming two things. A vaccine will arrive and we'll get back to normal, and the central banks are here for good, and there's going to be no exit policy as far as the eye can see. Any changes to those scenarios would be dramatic in the next 6 months.
Yeah. And with that in mind, Salah, with what Mike's just said in mind, those two big pieces, how do you play the next 6 months?
Totally agree with Mike. Really wonderful description. I mean, time is ticking away. We said we need a vaccine and Corona needs to go. We need to get rid of Corona. Now we have August. Corona numbers are rising on record highs. We don't have any vaccine, so time is ticking away and we need now a solution. If there will be no solution in the next 6 months, what I don't hope, then this could be dramatically a big, huge problem for the markets and, of course, for the real economy.
Salah, thank you very much indeed. Salah Bouhmidi from IG, Mike Dolan from Reuters, and Sujata Rao from Reuters. Thanks to all of you for your thoughts. Thanks again to John Jufus for his presentation at the beginning, and thanks to you for responding to those polling questions. We hope you enjoyed this webinar. I'm Axel Threlfall for Reuters. We'll see you next time.